We're here in Monte Carlo for the Rendez-Vous de Septembre. For AM Best TV, I'm Richard Banks. And I'm joined now by Karen Clark, CEO and founder of KCC. Karen, great to see you. Thank you for joining us.
Thank you for having me, Richard.
So we're expecting a lot of talk here in Monte Carlo about the California wildfires. Tell us a little bit about the latest developments in your US wildfire model.
Sure. Well, the LA wildfires of January actually validated the KCC model because, interestingly, our model that was in existence, for 2 years before the LA wildfires indicated to insurers and reinsurers that there could be 30, 40, $50 billion wildfire losses. And interestingly, there was a lot of skepticism because those numbers were higher than other models. So we had to convince companies that, we could have losses of this size and where and how they could occur. So it was hard to convince people until January of 2025. So the LA wildfires didn't cause any radical changes to our wildfire model. Basically, it was a validation of the model, and the LA wildfires were at the correct return period, about 40-year return period.
So traditional natural catastrophes remain high on reinsurers' agenda, obviously. What effect might changes in political funding priorities have on the information resources available to the reinsurance community?
Sure. Well, we, as you probably can guess, at KCC, our scientists, we gather a lot of information from NOAA and other sources. In fact, our severe convective storm model ingests over 30 gigabytes of data a day from all the satellites, all the radar, and all the weather models. So, and it's extremely important to our clients because we give live event reports on a daily basis. So, and it actually, our data is the basis of some new types of reinsurance transaction called modeled loss triggers. So it's vitally important. We are monitoring it continuously. The good news is everything is still intact that we need, and the data that KCC scientists use are primarily data used for operational forecasting, for warning systems, et cetera. So it's less likely or pretty unlikely that those data sources will be shut off. But we don't take that for granted, and we continue to monitor it.
So another topic that's likely to be high on the agenda here in Monte Carlo is AI. Can you tell us a little bit about how AI affects your business in particular, but the wider insurance industry as well?
Sure. Well, the most successful use of AI that intersects with catastrophe modeling are companies that are taking aerial imagery and using AI to come up with information such as roof condition, defensible space. Now, at KCC, we don't create that information, but we use it in our models. So we can take that data exposure in that data into our models to enhance the loss estimate. So we can say, for example, if the roof condition is poor, the damageability from hail is likely to be higher. If there's defensible space, then the vulnerability to wildfire will be lower. So to date, this is the most successful implementation of AI in the catastrophe modeling world. The interesting thing about catastrophe modeling is it was created to tackle perils for which there's very little data.
Yeah.
Okay, and this is the antithesis of AI, because for AI you need huge amounts of data. So for hurricane and earthquakes, there's not a lot of application of AI, but where we do see it more is for wildfire and severe convective storm, because these are the perils, as I said, we ingest high resolution atmospheric data in 3 dimensions daily. So we've archived terabytes of this high resolution atmospheric data, and we're using that to better model winds, complex wind patterns for wildfires, to be able to forecast phenomena like derechos and tornado touchdowns in advance. So it is fairly limited at this point with respect to the modeling, but mainly because for a lot of the perils we just don't have, a lot of data for the machines to learn on.
So finally, can I take your forecasting skills in a slightly different direction? What issues are being missed now in the wider general reinsurance industry that perhaps will matter most tomorrow, do you think?
Well, I think really it's not really the risk, but the opportunity. So obviously, growing risk is actually growing opportunity for reinsurers and ILS investors as long as they can feel confident that they can quantify the risk. So let's take climate change. Okay, everybody is worried about climate change. But in our newest white paper, KCC scientists have described how for hurricanes, wildfires, coastal flooding, inland flooding, looking out to 2050, even if we take the worst case scenario, it's relatively manageable by the insurance industry. So you do have to quantify it, and obviously those estimates will be revisited, every year or so to make sure they're still in line. But if we're talking about increases from less than 1% to a couple of percent per year, increases due to climate change, it is manageable, so it's an opportunity. And I think society in general is looking to the insurance industry to help manage the risk of climate change. Wildfire, obviously, for some companies, it was a surprise loss, but it also means that it's an opportunity. And for wildfires, the wildfire risk per capita in California is very small relative to example for hurricane risk per capita in Florida. So some of these, major events and climate change that may sound like, it poses new risks to insurers and reinsurers, yes, of course, but that also means there's opportunity as long as the risk can be quantified and investors and reinsurers can be confident in the models they're using to quantify the risk.
Karen, thank you very much indeed for joining us.
Well, thank you for having me, Richard.
For AM Best TV, I'm Richard Banks.